Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money.
Welcome back to the Investor Coaching Show. I'm Evan Barnard. All is off today. So, let's talk about 401ks now that we've set some groundwork for what are some of the metrics that people are using to try to beat the market and pick stocks and decide what to get in and out and predict the future. And then we have this ruling now, or executive order, that Trump wants to have private equity, alternative investments, real estate, digital currency, things like that in 401k plans. And is that a good idea? Well, great article by Jason Zwieg, one of my writers that I enjoy following. Very reasoned individual. Wall Street's big bad idea for your 401k. Recent moves by some alternative funds highlight the flaws of offering private assets to public investors. And I'll read some directly from the article, and we'll just get into some commentary. Wall Street is promoting a colossal lie. Money managers are in a desperate race to stuff illiquid so-called private market assets into funds anyone can buy, including your 401k. They say we all can earn high return and low risk with non-traded alternatives like private equity, venture capital, and private real estate. A close look at pending moves at two funds reveals how bogus this argument is and why investors should just say no to this juggernaut of alternative investments. So I want to pause here and create the distinction because we're enormous fans of capitalism around our office, and we are enormous fans of entrepreneurism and that entrepreneurial spirit that has made America the nation that it is. So if you are the business owner, if you have an idea, if you are creating a company and you're manufacturing this product or you're designing this service or piece of software and you're hiring and firing and you're dealing with the engineers and the developers and the coders and, getting in at 5 a.m. and leaving at 10 p.m., in our world, that's being a business owner and an entrepreneur. And for most people, if you're an entrepreneur and you stick with it, that is a higher return than you would get just picking the S&P 500. Now, tons of businesses go out of business. 50% go under in the first 5 years. So why did the survivors get that highest return? Because it's an enormous risk. And there is a relationship between risk and return. When you start to swim in these waters of private equity, you are no longer the business owner. You're not hiring and firing. You're not making the decisions. You're now trusting some other corporation or, company to do all of those things, and you're trusting them to tell you the truth. Well, that's a big problem. Not that private equity is all liars. That's not the point whatsoever. But they have no requirement to disclose a lot of the things that most people rely on to decide what's a fair price to invest in a particular investment. Why? Because you are operating at a very information deficient transaction. I kind of liken it to used cars. And in this area, we're exhorted to never buy a new car. A lot of people do, so forth. And I'm not getting into the sales rap, kind of like picking on attorneys. My point is, in a used car, or let's just say a used tractor, because I'm trying to find a tractor and I don't want to have to pay for a new tractor, but I want to make sure I get a good one that is going to service what I need it to do. Well, I have basically no information of that particular tractor that I'm going to buy. I know what I want it to do. I know what most of them do, but I don't know if that one has carburetor problems, engine problems, differential problems, whatever. But the seller does. The seller has tons of information on their side of the transaction, and I have basically no information other than it runs. Well, to me, private equity is very similar to that. You can say, well, they're in business, but you really don't have the visibility to know what they're doing. And so here's some interesting things that they're allowed to do because of the regulatory environment. And I think this really sets the stage for why we're not big fans of seeing this in a 401k. There was this particular fund, I think it was through Blue Rock, not BlackRock, it's actually Blue Rock, has a fund called Priority Income Fund, and they invest in private corporate loans. And it pays out a high yield at a rate of more than 17%. So if I stop there and you're thinking, well, gosh, the bank's giving me 2, this thing's got a high yield of 17%, this is a no-brainer. I got to put my money there or put my 401k money there. When you consider its total return, meaning its growth and its dividend, its total return is a different story. The fund lost 19.6% in the first 5 months of 2025 and 25.1% in the 12 months that ended May 31st. So here they can promote it pays a dividend of 17%, but yet it lost 25% of its value. Now, that's not a Ponzi scheme, but it sure kind of sounds very similar to the math behind some of those things. And so here's one of the other big issues, with a 401k, not that it's designed for easy access, and we'll talk on that in just another minute. Interesting article on people taking loans and distributions from 401ks, a lot more than previously, is private equity is a relatively illiquid asset. When you buy your house value doesn't change day by day, and selling a home is a pretty cumbersome process. You might engage a realtor, get an appraiser, this and that, get it ready. It's not like making a phone call and selling $50,000 worth of your mutual fund to go pay for a car or something like that. Well, private equity is very illiquid, just like that. And that's one of the advantages, they say, of private equity is the money is tied up for longer, and so we can get this higher rate of return. And previously, that's why private equity has been reserved for people that are accredited investors. Have a certain net worth above $1 million, income above $200,000, some various things like that. And as Paul said in the interview, which I hope you check out on YouTube with Chris Hand from Friday, is, the government just figures, well, they have enough money that they can afford to lose it, and so we'll let them buy whatever they want to buy. But they're wanting to protect previously smaller investors. Well, all of a sudden, that safeguard has been removed. If you're going to have it in a 401k plan, it's now just another choice, just like the other funds in your plan. And if we don't have any good track record globally, mutual fund managers or individuals, publicly anyway, have a great track record of choosing investments well with all of the public information that we have, why do we think that we're going to do better choosing investments where we don't have any information and it's a very one-sided transaction? So, we don't think that's a good idea at all. Certainly the 401ks that we manage, we don't do any kind of private equity or digital currency or things like that. To us, it's just very problematic and just is another way for investors to shoot themselves in the foot, either through emotion or lack of understanding and education or just, herd bias. A lot of people were in private equity in the break room, and so I'm going to put some in private equity, and you just may not even have any idea what you're getting into. So, yeah, we don't want to have anyone involved in that. And on 401ks, I was talking about people getting into their 401ks a little bit more. This is also from the Journal. Americans see their 401ks not just as nest eggs, but as rainy day funds. And so, the thought process behind the 401k, whether you use a Roth or traditional option, is I'm putting money back for retirement. In many cases, I'm getting a match from my employer, and so the dollars I'm putting in are already getting supercharged by that match. They grow for 20, 30, 40, 50 years, and even if you change jobs, it's growing in the next account for 20 or 30 or 40 years, so you don't have to stay with that employer. But it's a long-term thing, and it's designed for retirement. And Congress made them such that it's kind of hard to get that money out, and it is very costly to do that with the taxes and penalties and so forth. And in many respects, they won't even let you get it unless you leave the employer. Well, there were a few hardship withdrawal provisions that were put into the 401k code, and then that expanded some in 2022. And historically, people took about 2% of the participants in 401k plans took a hardship distribution in a given year. That's kind of the long-term average is about 2% of participants said, hey, whatever, I'm going to lose my house. I've got a medical bill. I'd lost my job and I need to get something out, hardship withdrawal. Well, in 2024, that was up to 4.8%. More than double the historic range. And if you look at the first 2 years of COVID, they were below the historic range of hardship distributions. And then 22, 3, and 4 largely correlated, I think, with some of the inflation and spending issues for people. It's now more than doubled from their historic rate of people rating 401ks. And some of that has to do with the government changing these rules. You can now get $1,000 out for almost any reason, and you can do that once every 3 years in your 401k plan. If you put that money back, if you put that $1,000 back, then you could take the $1,000 out the next year. So, it's really kind of an interesting deal that now people are starting to view at least part of their 401k as their emergency fund. And there's now a provision, and this I have to dig into. This was kind of new when I went through this article. You can save up to $2,500 in a money market type fund in a Roth 401k and withdraw it tax and penalty free. And so obviously the employer has to have that provision in the plan, but now the code at least provides for it that you could put Roth money into your company plan, and it has to stay in a money market. It can't be invested, and you could access that if you had an emergency or something. Well, they're kind of shooting themselves in the foot with people having all of this money for retirement. So it'll be interesting to see how this plays out over the years. But I would discourage you from viewing your 401k as your emergency fund. Certainly take advantage of the match. I'm not saying don't use a 401k for sure. It's a great opportunity. But make sure you're using it for how it's designed, and make sure you're funding yourself for a great retirement so that you can do what you want to do.
Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, dividends, living off dividends in retirement, real estate, life insurance as a retirement investment, and annuities, and interest-bearing accounts, and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. what's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax.
So millennials, here's an article. Joe Pinsker wrote this in Personal Finance. Millennials are richer now, so why can't they stop worrying? A generation that came of age during the 2007 to 2009 recession and then lived through the COVID-19 pandemic remains anxious. And so even though the data, we'll get into that, shows millennials doing quite well financially, they still don't feel it just because of their early experience with, those two significant events. But they're entering midlife wealthier than they or anyone else expected. But many of them fear it won't last. Mike Tonkinson finished law school near the end of the 2007-9 recession and spent several anxious months without a paycheck after his new job's start date was pushed back. The unemployment and foreclosures he saw in those years have haunted him since. You only have to watch The Big Short once and go, "Oh my God," referring to the movie about the era's financial crisis. It just makes you jumpy. Now, today, he's a homeowner, he's a practicing attorney, ample retirement savings, but he is still worried about his wealth and that it could suddenly disappear. And, fortunately, it's a good thing. He's keeping an emergency fund that could cover his expenses for years. Now, just thinking about that, because we'll talk about, what is the value an advisor provides next hour. But he may be sitting on way more cash than is necessary. And I think we all have increased our cash hoard a little bit since COVID and the country shut down for a few months. That will get your attention. But how much growth is he maybe missing out on if he's got like 3 or 4 or 5 years of cash in an emergency fund as opposed to something that's growing in at a much higher rate? But, millennials are also dealing with rising home values and stock prices. If they were able to buy a home, if they were an early millennial, they maybe purchased a home with a good rate, 2-3% mortgage rate, and they got an early start. But the later millennials towards the end of that time period, and all 3 of my kids are at the tail end of the millennial generation, those last 3 years that theoretically millennials run, is, they're in a very different situation buying homes and so forth than people that maybe were at the front end of that, because now they're dealing with 6% rates, maybe 7% rates, those kind of things. And so, it calls to mind that there is always this behavioral component to investing and to financial planning. You can study, you can have a game plan, you can save, consistently, take advantage of your match. Even doing the right things on paper, you look like you're really planning ahead and you're going to have a great future. But you can't discount the fact that we are emotional beings. And between greed and fear, there's always something that can mess you up. I was thinking about this last night. We were watching a show, and there was a particularly tragic scene. And, somebody had passed away from a health event, sad music playing and so forth. And we're sitting there in the living room watching the movie. I'm not involved. It's not a family member of mine. And yet that emotion comes up. And investing is no different. You can have all of the intuition in the world, but you still have this gut that is causing you to second guess the many things in your world. And those kind of decisions made based on fear or excitement, frankly, can really lead to some real problems.
Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.